What if I told you a company sitting on a backlog so massive it could buy entire small countries still managed to lose nearly $7 billion in market value in a single week? Sounds almost impossible, right? Well, welcome back to Smart Stock Sam, the channel built for traders and investors who refuse to trade blindly. Today, we are tearing apart Supermicrocomputer, ticker symbol SMCI, in a deep dive I'm calling SMCI Stock Analysis, covering the death cross on the chart, the brutal dilution event, and the exact price targets smart money is watching. By the time this video ends, you will understand exactly why this AI darling cratered, what that death cross actually means for your money, how a $7 billion dilution event reshaped the entire risk profile of this stock, and most importantly, the precise price levels traders are watching going into the next session. We are covering the capital raise, the governance scandal swirling around the company, what institutional giants like Jane Street are really doing behind the scenes, the technical breakdown, the options market positioning, and finally, a complete actionable trade setup with entry, stop loss, and profit targets. Stick around until the end, because the very last chart I show you could completely flip your entire view of this stock, and the trade setup right after it might be the most important 15 seconds of this whole video. Let's get into it. Let's start with the brutal headline number. In just 5 trading days, shares of SMCI cratered by 30%, erasing $6.8 billion in market capitalization like it never existed. Could a single press release really wipe out that much value overnight? It sounds almost too dramatic to be true, yet that's precisely what unfolded. Think about that for a moment. An amount of wealth larger than the annual revenue of entire industries, simply gone within the span of a single trading week, while the company's actual order book never stopped growing in the background. The close price settled at $27.78, and the culprit wasn't some catastrophic earnings miss. It was a historic collision of two opposing forces. On one side, off-the-charts AI demand that most companies would dream of having. On the other side, negative cash flow, brutal shareholder dilution, and governance fears that have been quietly simmering for months. Management was forced to announce a $7 billion equity financing package just to keep pace with AI orders, and the market did not take it well. Dilution fears took the wheel completely. But here's what's fascinating. While the headline growth numbers look spectacular, there's one hidden metric coming up later in this video that could completely change how you value this entire company. So where exactly is this $7 billion actually coming from? This wasn't a simple single stock offering. It was a highly engineered 3-part capital raise. First, the company issued $1.25 billion in common stock, priced at $27.50 per share. Picture the company as a pizza that just got sliced into millions of extra pieces. Your slice is now smaller, even though the pizza itself didn't grow. Second, they issued $3.75 billion in 7% mandatory convertible preferred shares, priced at $50 each. And finally, a $2 billion at-the-market program, often called an ATM. Here's why that last piece matters so much. An ATM lets the company quietly sell shares into the open market whenever it wants. Could that single mechanism act like an invisible ceiling, suffocating every single rally before it even gets started? Almost certainly, yes. Anytime the stock tries to push higher, management can simply sell more shares to raise cash, capping the momentum before retail traders even notice what happened. It's a quiet mechanism, but it's incredibly effective at keeping a lid on enthusiasm. But why would a company with such enormous demand need to raise $7 billion so urgently? To understand that, you have to understand the capital-intensive reality of AI hypergrowth. SMCI is sitting on a jaw-dropping $39 billion non-binding backlog. Incredible, right? But to actually build those servers, they have to purchase astronomically expensive components, NVIDIA GPUs among them, long before customers ever pay them back. In just one quarter, their operating cash burn hit a staggering $6.6 billion. Right now, the company is carrying $8.8 billion in debt, while holding only $1.3 billion in cash reserves. Could a company with this much demand somehow run out of cash before the orders even ship? It's a real risk, and that tension is exactly why this $7 billion raise happened. When you actually run the math, this wasn't a sign of operational failure. It was a mathematical necessity for survival. The engine simply needed fuel to keep running. Now, none of these numbers matter if the underlying business itself isn't sound, so let's look at the foundation. And honestly, SMCI is innovating at a breakneck pace. They just closed a $2 billion strategic partnership with Gorilla Technology to expand aggressively into India. Even more interesting, they signed a brand new agreement with Nano Nuclear. Why would a server manufacturer suddenly care about nuclear energy? Because next-generation AI data centers demand an almost incomprehensible amount of electricity, and SMCI is trying to get ahead of a looming power grid crisis before it ever has the chance to choke their growth. On the product side, they're rolling out new rack-scale AI platforms, deploying AMD Helios systems, and expanding their ARM AGI-based server lineup. In other words, they are aggressively locking down their hyperscaler relationships, while everyone else is distracted by the stock price drama. Could this aggressive innovation pace eventually outweigh every single one of the headlines currently dragging the stock lower? It's a question worth keeping in the back of your mind as we move forward. So if the business itself looks this strong, why is the stock collapsing? Because right now, SMCI is operating underneath a heavy, dark governance cloud. The United States Department of Justice has unsealed an indictment charging 3 individuals, including an SMCI co-founder, with conspiring to smuggle at least $2.5 billion in American AI technology to China. Now, SMCI itself is not named as a defendant, and the company says it's fully cooperating. But could this kind of regulatory overhang quietly scare away the exact institutional investors this stock desperately needs? Unfortunately, it already has. And to make matters worse, right before that $7 billion dilution event was even announced, CEO Charles Liang and director Sarah Liu collectively dumped 680,000 shares of their own stock. Coordinated insider selling, timed right before a massive, dilutive capital raise, is one of the fastest possible ways to destroy retail investor trust. And this is where the story gets genuinely confusing, because the ownership signals are flatly contradicting each other. On one side of the scale, you have the entire C-suite dumping shares, deepening what Wall Street analysts now call a governance discount. But flip to the other side, an institutional powerhouse Jane Street Group just disclosed a massive 8.5% passive stake, scooping up more than 56 million shares. Could this be the ultimate vote of confidence from smart money? Before you get too excited, here's the catch. A significant chunk of Jane Street's position is strategically tied to that newly issued mandatory convertible preferred stock. In other words, they're running a highly sophisticated arbitrage play, not necessarily making a pure directional bet that this stock rockets straight to the moon. 2 completely different stories, told by 2 completely different sets of shareholders, all happening at the exact same time. So when you connect every single one of these dots, you realize something important. Supermicrocomputer has essentially become a hostage to its own hypergrowth. Let me walk you through the logic. The market is punishing SMCI for diluting shareholders, but that dilution is really just a symptom. The actual disease is the DOJ investigation. Because of that legal and regulatory risk, traditional banks simply won't lend SMCI the billions of dollars in debt financing they actually need. And because that debt financing route is effectively blocked, management is forced into immediate equity raises instead. That equity raise massively dilutes existing shareholders, but it also funds the $39 billion AI backlog. The growth absolutely continues, but at a severe, painful cost to anyone currently holding the stock through this entire cycle. So how is smart money actually adjusting their models in response to all of this? The analyst consensus has clearly shifted, and Wall Street now leans heavily toward a hold rating. Wolf Research just initiated coverage with a peer perform rating, essentially a polite way of saying hold, citing heavy legal uncertainty alongside looming margin pressure. Raymond James went even further, slashing their price target from $45 all the way down to $39, adjusting their entire valuation model to reflect the sudden expansion of the share float. Even Mizuho, despite nudging their target slightly higher to $44, is maintaining a neutral stance. They acknowledge the incredibly strong AI demand signals, but warn that severe component supply constraints could limit any meaningful near-term upside. Now let's strip away every single opinion and look strictly at the technical mechanics, because the chart itself tells a brutal story. Across every single daily moving average, the current trend is screaming strong sell. The MACD indicator sits buried at negative 1.12, and the 14-day RSI has dropped all the way down to 26.418, which signals the stock is deeply, historically oversold. But the single most alarming technical event on this chart is the death cross. That's the moment where short-term moving averages violently pierce below the 50, 100, and 200-day moving averages. Could this stock claw its way back above all three almost immediately? The odds right now say no. The 50-day moving average, sitting at $32.26, is acting like a rigid iron ceiling of overhead resistance. We do have immediate structural support attempting to hold at $27.75, but if that level cracks, the ultimate floor, the 78.6% Fibonacci retracement, is waiting all the way down at $26.31. Every single one of these indicators is flashing the same warning in unison, and that kind of alignment is rare enough to take seriously. But a chart only shows you where a stock has already been. The derivatives market tells you where it's actually being forced to go next. Welcome to the options wall for the June 18th expiration. Right now, there's a massive gravitational pull happening around the $30 strike price, with nearly 35,000 combined calls and puts acting like a giant magnet, pinning the price action right at that level. If the stock somehow tries to break out higher, it's going to slam straight into brick walls of call resistance at $31.50 and again at $34. Market makers will actively short the stock to hedge those positions, which essentially guarantees that any sudden rally gets aggressively sold right back into. And on top of all that, short interest has surged to 13.21% of the float, with an explosive 567% spike in short volume on June 11th alone. Could this many bears really be wrong all at once? It's possible, but right now they are firmly in control, and until that short interest figure starts cooling off, every single rally attempt should be treated with healthy suspicion. So what does all of this actually leave us with? An investor's ultimate dichotomy, SMCI, is fundamentally cheap but technically broken. On the bullish side, the stock is trading at a forward price-to-earnings ratio of just 14.6 times. For a company projecting triple-digit revenue growth alongside a $39 billion backlog, that valuation is historically, almost shockingly, cheap. You also have Jane Street acting as a credible institutional anchor underneath the stock. But on the bearish side, you're fighting an active death cross, a $6.6 billion quarterly cash burn, forcing further dilution, and that suffocating DOJ overhang choking off access to traditional debt. This is a genuine battle between long-term intrinsic value and short-term mechanical destruction, and right now, the mechanics are winning. Forget the daily price noise for a second, because there are really only three dials that matter going forward. Number one, gross margin durability. Margins recently recovered to 9.9%. But if SMCI is secretly discounting servers just to win that $39 billion backlog and fourth quarter margins slip back down towards 6%, the dilution math compounds and could genuinely crush this stock. Number two, the cash conversion cycle. The company is sitting on $11.1 billion in inventory right now. That $7 billion raise is really just a band-aid. They have to convert that inventory into positive free cash flow, or they will almost certainly be forced to dilute shareholders again next year. And number 3, the DOJ legal status. Until that investigation is cleanly and fully resolved, the heavy governance discount sticks around, and top-tier institutional capital is going to stay firmly on the sidelines. Watch these 3 dials closely over the coming quarters, because they will tell you far more than any single day's price action ever could. So here's your actual, highly actionable trade setup based on the June 18th parameters. We know SMCI is deeply oversold, yet still trapped inside a broken technical structure. My honest prediction is a volatile, choppy consolidation range somewhere between $26.50 and $31. If you're hunting for a short-term scalp or swing trade, watch closely for price stabilization alongside heavy volume around our structural support entry zone of $27.75. And if you do take that trade, you absolutely must use a strict stop loss at $26.31. If that 78.6% Fibonacci retracement breaks down, the floor genuinely falls out from underneath this stock. Your primary profit target sits right at that massive options magnet of $30. And if price somehow chews straight through that level, your secondary target becomes the 50-day moving average resistance at $32.26. So here's the ultimate verdict. Right now, Supermicrocomputer is a high-risk, event-driven trading vehicle. It is not, I repeat, not a safe buy-and-hold investment at this exact moment. Yes, they possess staggering demand and an enviable $39 billion AI backlog. But until management proves they can execute those orders with sustained double-digit gross margins, and until they finally clear the DOJ legal cloud, forcing these brutally dilutive equity raises, the risk profile here remains far too high for passive, set-it-and-forget-it investing. A genuine long-term bullish thesis only reactivates the moment we see a confirmed daily close above $32.26. Could that single technical event force a wave of mass short covering and finally clear the immediate gamma barriers above the stock? Absolutely, and that would be the strongest signal yet that the worst is truly behind it. Until then, protect your capital, respect your stop losses, and never catch a falling knife blindly, no matter how tempting that $39 billion backlog might look on the surface. Before we wrap up, a quick but important disclaimer. Everything covered in this video is for educational and informational purposes only and should never be treated as personalized financial advice. I am not a licensed financial advisor, and stocks like SMCI carry significant risk, including the very real possibility of losing your entire investment. Please always conduct your own independent research and consider speaking with a licensed financial professional before making any trading or investment decisions. Now, I want to hear directly from you. Drop a comment below and tell me this. If SMCI closes above $32.26 next week, would you actually trust that breakout? Or would you assume it's just another short squeeze waiting to fail? I genuinely read every single comment, so let's get a real conversation going down there. If this breakdown helped you see SMCI more clearly, please smash that like button. It genuinely helps this channel grow. Make sure you're subscribed with notifications turned on, because we cover breaking stock setups like this one constantly, and you do not want to miss the next one. If you found extra value today and want to directly support this channel, you can send a super thanks using YouTube's built-in support feature. Every single contribution means the world to me and helps me keep these deep dives completely free for everyone. And finally, if you're serious about leveling up your investing and trading game, come join the Smart Stock Sam membership community. Inside, you'll get exclusive, deeper analysis, early access to trade setups just like this one, priority replies to your queries, and a genuine community of serious traders working to sharpen their edge together every single week. This is Smart Stock Sam, signing off. Stay disciplined, stay patient, and I'll see you in the very next update.